this segment, we are going to discuss internal controls. So companies use internal controls, which are policies and procedures. These policies and procedures are intended to protect assets from theft or misappropriation, to ensure that only valid transactions and all transactions are recorded and reported to ensure reliable accounting. It helps promote efficient operations by providing policies and procedures to guide employees in operations, and it helps urge adherence to company policies by communicating expectations for operations. In 2002, federal legislation was put in called the Sarbanes-Oxley Act. It's also known as SOX. And this legislation requires management and auditors of publicly held companies. By publicly held companies, I mean companies who have stocks that are publicly exchanged on one of the stock exchanges. All of these publicly held companies are supposed to adhere to or perform specific requirements, such as they must evaluate internal controls. A public company accounting oversight board called the PCAOB was created, and it oversees auditors of public companies. This act also restricts the consulting services performed by auditors. It puts term limits on a person leading the audit, and it has instilled harsh penalties for violators. Please focus on this first item, evaluation of internal controls. Internal controls are important, and they're so important that the Sarbanes-Oxley Act now actually requires companies to have those internal controls evaluated as part of their regular audit. There are fundamental principles that underlie all of the policies and procedures that a company puts in place to act as internal controls. And those policies and procedures establish responsibilities, who is supposed to be doing what, require the maintenance of adequate records. There must be supporting documentation kept and held onto. It ensures assets and key employees are bonded. When we bond employees, it's essentially taking out insurance on employees that hold a key role in the company. Separate record keeping from the custody of the assets. Divide responsibility for related transactions. And apply technological controls while performing regular and independent reviews. These principles guide how a company's policies and procedures that make up their internal controls are implemented and maintained. Even with the best system of internal controls, there are limitations. And those limitations are due to the fact that humans are primarily the ones responsible for implementing and ensuring internal controls exist. Those limitations are due to human error. Humans are imperfect. They make mistakes. And that human error can be due to negligence, fatigue, misjudgment, or confusion. Or the limitations are a result of human fraud, or the intent to defeat the internal controls or circumvent the internal controls for personal gain. Ultimately, a company must decide whether the cost of the policies and procedures exceed their benefits. And if the benefits exceed the cost, then the internal controls are well worth the efforts and time.